All right. Well, thank you everyone for joining us. I'm excited about today's masterclass on how investors can use value added to win deals and grow their portfolio companies. For those of you I haven't met, I'm Danielle Patterson, CEO of Family Office List, and it is a pleasure to have you all with us. I'm excited about today's guest speaker, Ben Hart. I do recognize time is our most valuable asset, so I am very grateful to Ben and to all of you for joining us and spending this next hour together. We make these live really so that they can be engaging, and today's presentation will be no exception to that. Ben and I are going to keep things really conversational, and we'd love to include you in the conversation. So the chat is enabled, but I encourage you throughout, so things don't get buried and lost, to use the Q&A. For those of you who are new to our masterclass, our goal is really to provide valuable insights and to foster meaningful discussions that empower our community. Anything that comes up in the world of family offices that we're curious about, that's what these masterclasses are here for. So before we dive in and I introduce Ben, just a few little housekeeping notes. Anyone who's just joining now, the chat is enabled. Feel free. This is a fun way. Introduce yourself, share where you're from. You can drop your LinkedIn URL. The Q&A, any questions throughout, we like to make this engaging, so feel free, drop questions there. I'll do my best to ask those that I've prepared, but also incorporate yours into today's discussion. I will record the session, so tomorrow I'll follow up with the recording. I'll also share Ben's Calendly, which he generously dropped in the chat earlier, so that if anyone wants more one-on-one time, you're welcome to do that. Last thing, and let me see if I can do this. I'm not as accustomed. We prepared a poll, and this is fun because, let's see, poll. I'm going to launch a poll. We just love to know, who has familiarity in the topics we're discussing today, value add and secondaries. So feel free, while I'm going to be introducing Ben, to complete our poll, just so Ben's got a great base level understanding of everyone's expertise, areas of interest, level of experience, so that he's not talking below or talking above, but that will definitely help guide today's discussion. So the poll has been launched. So yes, that's all for housekeeping. So to get started, we'll learn a little bit more about our distinguished speaker, Ben. He is the founder and CEO of Readily, which is a trusted partner in venture secondaries, providing access and liquidity solutions for VCs, family offices, and founding teams. His impressive career includes serving as director at Insight Partners, currently managing $80 billion in assets under management, making it one of the largest multi-stage investment firms in the world. Prior to that, Ben gained valuable experience in early stage venture at Plug and Play VC, where he worked closely with startups and served as a startup mentor at Endeavor, where he guided founders in growth and marketing strategies. And his career journey has taken him to all sorts of exciting corners of the globe. He's lived in London, Munich, Silicon Valley, and he's now in New York. His deep expertise and global perspective really make him an expert. So I'm excited that we get to spend the next hour or so together, really learning about value add strategies and secondaries. So without further ado, Ben, thank you so much for joining us today, and I'm really looking forward to our conversation.
Yeah, no, thank you so much, Danielle. It's really wonderful to be here. Appreciate everyone giving a little bit of time for this session as well. And I was saying just before, I'm not sure if everyone was part of it, but I really love what you're doing with Family Office List. So it's really exciting to be with you today.
Oh, thanks, Ben. Well, I know I read the bio, which I promised I would never do when we had a masterclass on storytelling. They're like, why read the bio? I mean, backstory is one of my favorite things. It's such a great way to really get to know you and to understand your expertise. So without needing to spend too much time, but loving to really hear it from your own mouth, I was hoping you could just share a little bit more about this journey of yours and how it's really led you to have such expertise in value add and secondaries.
Yeah, totally. Yeah, so I guess going back, I started out in London after graduating. I grew up in England, was working in strategy there. And, I mean, first few years of your career, it's all about getting all those core skills under your belt, right? Um, One of the projects that I came into was I was working with a large tobacco company who was trying to do the next generation of products. And so they were looking for new innovative technology solutions that they could start to move away from tobacco in. It's not an industry I love working in, but I thought that was a pretty interesting challenge. As part of that, I think growing up in London, you don't really hear too much, or maybe you do nowadays, but I didn't really hear too much about Silicon Valley and early stage and growth stage technology. And I really wasn't familiar with venture capital at all. And so as part of that project, I started sourcing interesting new technologies, which I was finding increasingly were coming out of the US and particularly in Silicon Valley. That became really interesting to me, and so I started digging deeper into venture capital. I knew I wanted to leave the UK and get some global experience and live in some new places. And so I went and was applying to all of these different VCs across the world. One of them was in Singapore, and they basically said to me, hey, we've actually just closed out this position, but we'd love you to interview for our Silicon Valley early stage fund. So, hey, that sounded great to me. I went and interviewed, and it all went really well. I moved across to Munich first while I was waiting for my visa to process. I think if there's anyone who's on and has moved to the States and tried to
Oh
get
yeah.
a green card, it takes a bit of time. Uh, and so, yeah, I was in Munich. I was working on early stage VC. Primarily there, I was diligencing seed stage investments and a bit of pre-seed on insurtech and fintech. Um, After that, my visa came through. I moved across to California. I started working for that same VC out on the West Coast. An extension of the same work, but then I also started building out a lot of their insurance accelerator program. So working with really early stage startups as they were going out and trying to find, hey, how do I find product market fit?
Yeah.
Getting, corporate feedback from them, from a lot of large insurers. Really amazing work. It was a, total exposure to all of the different funds in the Valley, as well as to, the kind of founder culture as they're
Yeah.
starting up companies.
Yeah.
So it was really incredible. And after that, about 3.5 years, 4 years after that, um, I had been networking a lot, and I met one of the partners at Insight Partners, and they basically said, hey, look, there's a position on our team to come out to New York if you're interested. So decided, hey, sounds like a great idea. Moved across to New York about 4 years ago now, and was working as on the enterprise tech, primarily on the growth stage team. So for those that don't know, Insight Partners is a large multi-stage fund. They do seed through to post-IPO. You mentioned it, around about 80 billion under management, so it's of real scale. And I was working with founders like the folks at Wiz and Writer and Abnormal
Wow.
Security, just some of those amazing companies who are hitting these high inflection points. And they were trying to figure out, okay, what does the go-to-market strategy look like, and how can I crack down new customers? So I was partnering up very closely with them doing that. It was really wonderful. I then also built out the accelerator program for Insight, which was, again, just an amazing experience. About 6 months ago, after doing that, I was working with these different founders who were, hitting this inflection point at Series C or D, and a lot of them were starting to think about secondaries, or at least have them on their radar. And so, from a talent retention and attraction point of view, that became interesting. Um, in parallel to that, Insight had launched a continuation fund, which is a form of secondary. And so there was more activity around the space. I started speaking and digging into friends of different funds across both the coasts, as well as in Europe, and secondaries just were bubbling up as top of mind. So did some research. I actually got my green card through as well, which meant that I could go out and build my own company.
Congrats.
Um,
Amazing. Yeah.
yeah, and so started Relay about 6 months ago, and so yeah, that's the most recent endeavor. And what we're doing is we're working with about 65 institutional investors, from growth funds to crossovers, private equity funds to large family offices, helping them to get exposure to secondary. venture secondaries, as well as helping early stage funds and founders to transact and sell shares via the secondary market. So yeah, I think that kind of brings me up to date.
That's amazing. What an awesome journey. And yes, having been married to a South African, I know the difficulty in getting those green cards. So congratulations. And I love seeing, all this rich experience all kind of lead to, I can't believe just 6 months ago, starting your own gig. This is great.
It's been a really exciting journey. It's fun to be an entrepreneur, and yeah, it's going really well. So that's all positive.
Good, amazing. Well, I'm looking at the results of our poll, and if anyone hasn't had a chance, feel free, it's still open. But I'm definitely seeing that some people aren't very familiar with this concept of value add. So I thought that would be a great starting point. Let's just start with the basics. What is value add, and why do venture funds build specialized teams around it?
Yeah, that's a great question. And I think taking a step back, it used to be that funds would choose founders and, they would go out into the world, and if they selected a founder, they would get access to that deal. I think that began to shift as there were more funds, and, I think the talent pools of really highly talented founders are still somewhat slim. And so you think as a fund, okay, how can I differentiate? If I'm providing capital, what are my differentiations on top of that? That's where I think the value add services started to come in. And so you have funds who show up in the market trying to win founders over to invest in their latest round by using value add on top of the capital that they're providing. And so it went from just capital now to value add services plus capital. And so, what does that actually look like in practice? I think there are so many different forms that value add can take in the venture market, and every fund is unique. And some do it well, some do it not so well, and some different parts of their journeys. But I think there are some great lessons to be learned from how funds are doing it. So happy to kind of share some of those if that'd be helpful.
Yeah, I want to dive deeper. Like you mentioned that there's all different ways, different types, different models. Can you elaborate on that a bit?
Yeah, totally. Yeah. So I mean, I think, and I think hopefully this is helpful for folks who are listening, both in terms of if they are, showing up as a fund who's looking to invest in venture, what are the value add that we can, bring to those founders, as well as I'm sure a lot of folks actually are also investing in funds. So perhaps this will help you at least assess some of those services that funds you might be looking to be an LP in would be, deploying, and how can you think about that? So I think value add takes a lot of different forms. I think there are kind of 8 key forms that I've seen it take, and some do all of those things. Some just do 1 or 2 and specialize. Looking across those 8, so I think the first is business development support and sales and customer success. So what does that look like in practice? That could be, okay, we as a fund have a great network of customers, and we want to help those customers, those founders understand who their target buyer is in those enterprises. And so if you've got a good network, you can start to make introductions. It's a great benefit for the founder, because then they can start to develop out, what their ideal customer profile looks like. It could look like customer segmentations. Just, if you have deep expertise in understanding what different customers look like and helping founders to understand who their profile of different customers are, that can be really helpful. On the BD side, again, I think new market and vertical entries are both really interesting. So I've seen funds who have differentiated 100% on market entry into, for example, Japan. And their whole go-to-market is, we will help you as a founder access the Japan market.
Yeah.
And I mean, what a wealth of experience to bring. And if you can do that well, I mean, that's incredibly differentiating to win a deal.
Absolutely. Wow. Find your niche.
So those are a few on the BD side. On the talent side, executive coaching is, an obvious one. I think if you are someone who has built a company, have, teams who have helped others build companies, then some of that executive coaching for a founder can be incredibly valuable. Hiring an org structure within that. So, making those key hires, if you've got some talent and perhaps they, I don't know, want to expand to Chicago, and they want to make their first GM hire there. Well, if you have a great network there, that's incredibly additive.
Hmm.
And there's actually some funds who 100% differentiated based on talent as well. So, I mean, if folks are interested, look out. Swell and TCP are two funds they've kind of originated from recruiting backgrounds, and then they became a fund.
So Swell and TCP.
That's right. Yeah.
Awesome. I'll look those up.
And one of them, I think TCP started as being, they did SDR hires for first hire on the sales team, and now they have a fund out of that services business,
How incredible.
which
Yeah.
is really interesting. Engineering and product. So, if you are someone who's built companies and maybe tech companies, maybe not, doing those technical product roadmap reviews with founders can be incredibly additive. Understanding and getting into the code. Not everyone is a coder. I'm not a coder, but if you can, wow, what an amazing thing to be able to do, right?
Amazing. Yeah.
Marketing is another one. So hands-on marketing support and lead gen, and understanding what the ROI of marketing is. I think these things sit across the different functional areas that a business is building naturally. And so if you can lock into one of those functions, it's super additive for a founder, and it just helps them to scale their business, and they know who to call for that thing. And going back to funds in that space, I mean, there's a fund called Bullish, who are doing exactly that. They are kind of a marketing consultancy with a fund attached at the hip. And so they are hyper specialized on that space.
That's amazing. It's hard for these founders to be specialists in everything and wear every single hat, but oftentimes they're asked to do that. But this is great. It's just this huge support network. I love all the different ways in which value add can apply.
Yeah, 100%. It's and it could look like investor intros is the fifth one, where if maybe you have other GPs and family offices you can invest with, and being able to bring them in is hugely additive, because a round can close, or if they need another source of capital for, I don't know, maybe they're raising some debt. This is helpful. I think one that's really interesting, which I think is lesser spoken about, is the legal and regulatory side of things. And so I've seen funds who actually have, yes, you've got the kind of pure play legal support, like setting up an LLC and providing counsel on demand, all those things you'd expect. There are some funds who actually, they specialize around helping founders navigate regulatory hurdles. And so,
yeah, save a lot of time, money, and heartache, I'm sure, you don't have to make these very, costly mistakes.
Yeah. 100%. And it's Tusk Venture Partners is an interesting one who's doing that. If anyone is interested in looking them up, it's entirely around high regulatory industries.
And I'm sure it varies, depending on where you're located, the laws, it's very nuanced. So
yes,
the particular fund you mentioned, are they location specific, or do they help founders in any location?
Yeah, my understanding is that they are focusing in on industries which maybe have, high regulatory hurdles to be able to jump, and there's actually some regulatory capture perhaps in there. And so how can a new founder build a company and navigate those while scaling?
Yeah, it's a lot. That's tremendous value.
Yeah. And then I think that the final one is the personal founder development. So, and this can take so many different ways. It's, particularly if you have a family office, to some extent, I mean, that is all understanding of how to steward wealth.
Yeah.
And so if a founder is aspiring and, trying to generate generational wealth, then at some point they're going to have to manage that and help to steward that themselves. And so I think some of those kind of personal founder development things can be really interesting as well.
Yeah, turn our founders into funders. I love it. Just like the mindset, it's a mindset thing for sure.
Yes.
Well, that's exciting. And you kind of touched on the ways that family offices are included into this value add. And I'm curious, how do they position themselves, family offices specifically, when they want to deliver value investing in venture?
Yeah, so I think it's really interesting. I think the dynamics are different because, of course, a venture fund, they have LPs, of which maybe a family office is also an LP.
Right.
And they therefore have their, tenure of the fund essentially, which can be maybe on average around 10 years, maybe a little bit more. And so they need results in that time frame. I do think that family offices, some of the capital side of it is there's a patience there, which can be amazing. And so if you are, long-term investment strategies, there's not kind of pressurization of short-term, wealth creation, then that can be incredibly additive to a company. And so, for example, I'm currently working with a company right now that's raising $70 million, and they decided that they do not want to scale and be invested in by venture funds. They actually prefer family offices for this exact dynamic. So,
Yeah.
so there's some dynamics in the capital side. I also think, every family office that I've spoken to has always come from a unique background. And so, this may be really elementary for everyone who's listening, but that is all experience to be transferred. And so if someone is building a company and you have a deep expertise in, I don't know, maybe it was you came from media, and then maybe the double down is on the value add side. Okay, we're going to help you on 100% on your PR. And so there's a transferability, I think, between what the background of a family office is and how I think they should show up in market, and just absolutely nail that one piece of value add that, was the experience that they came from originally. So I think that's a big lesson that I've kind of learned whilst having these conversations.
Yeah, I mean, I feel like that's my world. It's focusing on what makes each of these family offices unique, and
Yes.
the way that they bring value. It can be so many different angles that you look at, whether they have expertise in the area they've acquired their wealth, or they are deeply networked, but patient long-term capital. I mean, there's so many different angles in which people can look at it. And
Yeah.
because no two are alike, it really does take doing your homework and understanding where each family office has come from.
Totally. And yeah, and I think the in venture, for a founder, they want to be interacting with a GP at least by the end of the deal. And
Hmm.
so in the very same way, I do think that, whoever who's built the company to make a family office,
Yeah.
there has to be an engagement level from that person.
Hmm.
Because that is essentially what I see as the equivalent of the GP relationship in venture.
Yeah.
And they're going to want to learn from them. And that's where I think a lot of the value transfer can happen.
100%. So for these family offices that are really passionate about venture and they want to share their expertise and become involved, what are some of the best access points where they can access and get involved in venture today?
Yeah, I think that there's two key access points that I see right now. One is obviously investing via funds, and I'm not saying anything new there. That is specialized expertise around venture. I'm sure all of the reasons why you would want that are clear. It means you're investing in someone who is at the center of information flows for that space. And so their entire mind share is being taken up by whatever is happening in that. They're seeing things come, they're seeing things go. And so investing via funds, obviously, number one. I think there's this really interesting new phenomenon, which is the company I'm building, of course, in venture secondaries. And
Yeah.
so I think, for those that don't know, venture secondaries, it's existing pools of capital, of equity that have been bought from a company during primary rounds in the venture life cycle. And it's then owned by funds or founders or employees. It can then actually be bought from them by other investors in the secondary market. And so I think it's a really interesting access point for family offices.
I'm curious to know. I mean, to be honest, I've heard secondaries come up more and more, and we always look to our data to tell us the appetite of family offices and what they're looking for. So to me, secondaries is one of the filters that we can apply. And I only really learned about what it is, which you just shared recently.
Yeah.
But I try to think, like, how do you go about finding how are secondaries listed? Is that, what you're doing at Readily? How, or are the opportunities created by going to shareholders and asking if there's, desire to sell?
Yeah, so I think there are kind of three main access points for the secondary market, and they all have their own pros and cons. And I think even just understanding what that landscape looks like as an access point is really
Mhm.
important.
Yeah.
I think or maybe actually four main access points. Number one is, using banks. And so banks often will have deal flow that is shared there through their wealth desks. And, that is often secondary deal flow that can be invested in. That's number one. I think those deal sizes typically range, they're always 100 million plus in my experience to make it worthwhile for a bank.
Right.
Um, and I haven't seen too much differentiation across some of the things that they're sharing. Number two is there are marketplaces. I'm sure folks have come across some of those. Those are much smaller. Usually, in my experience, have been kind of, 200 to 500K in volume, dollar volume, per deal. And you can just log in, you find things you're looking for. I think some of that is okay. I think some of the cons of that are you don't know if it's real, if it's a broker on the other side of that, or, it's very hard to get a read of what's going on there. Number three is kind of specialized folks like ourselves. And so we are designed for institutions. We work very closely with them. They give us targets. We also share interesting flow that comes from, our experience in venture and understanding what good looks like. Um,
Hmm.
and so, we form close partnership-oriented relationships. It's not transactional. It's very much, getting to know one another and building up relationship. And then number four is just outreach, to your point, right? And so
Yeah.
really liking a company, you can do some outreach, and there is equity pools out there which are accessible, from early stage employees or founders, or even investors.
Yeah. And I wonder too, just educating people on the option of this. Yeah. And so why are secondaries really appealing to investors? What are some of the benefits?
Yeah, so I think the use cases for secondaries are number one, exiting and managing a portfolio.
Mhm.
So on the exit side, if you're selling, there's a lot of pressure being put onto funds right now to generate DPI, to transfer money back to the folks who have invested in them. And
Right.
so it's a great tool to, almost force function for that DPI to come through. You don't need to wait for the organic IPO. IPO window has
Mhm.
been put off for a long time now. M&A is still, here and there. There is a bit of
Right.
activity right now.
Right.
Secondaries are the third exit point where you can sell it to someone else who's interested in buying it. So I think that's kind of the first use case. Second use case for secondaries I see is access points. So whereas a primary raise, you might need to win the deal and be a
Mhm.
part of that raise. Secondaries actually you can be quite selective, and they're not, put under the pressure of a primary raise. So you can kind of point and choose and select. Of course, it's not that easy in practice, but
Right.
it gives you a lot more flexibility, right?
Yeah. Yeah.
Um, and then third is topping up. So if you love a position you're already in, you can use the
Mhm.
secondary market to get a better cost basis on
Yeah.
the same investment and top up on and get more volume. Um,
Yeah.
so those are kind of the three use cases I see right now on the secondary markets.
That's really interesting. And I guess, thinking from a perspective, in a investor standpoint, would you say the secondary market, I mean, it's the investment is a bit de-risked because it's a later stage and the company's already kind of proven its track record, or is
Yeah.
that, yeah.
Yeah, I totally think so. There is usually secondaries are a little bit later stage. So to your point, yeah, they're a lot more de-risked at least than, very early stage venture. Um, I think some of the other perks of using the secondary market is, you can use insider information,
Hmm.
and, that those information flows can actually give you a competitive edge, which is great.
Yeah. Yeah.
Um, I think you can also piggyback on the approval of a selling party. So, for example, we've had situations where maybe a family office has not been able to access the company because you still need founder approval.
Hmm.
Um, but the selling party has a unique situation where they say, we're able to transact and sell on this because we have a special condition that was baked into our early contract. And so you actually can get the approval put into place via the selling party. So I think that's a really nice perk of secondaries. And
Absolutely.
yeah,
Yeah. Well, I'm looking at our poll again just to see who in the crowd really does currently participate in secondaries. And no one allocates over 25% of their portfolio, but there are some 10 to 25. And I'd love to know, again, just kind of circling back to this world of family offices,
yeah.
really, like, why should they consider secondaries in their portfolio? And in terms of the percentages there, I mean, I know this is your expertise, but what kind of advice in terms of the amount of their portfolio they should think about allocating?
Yeah. I mean, I think about the amount of the portfolio, that's of course around dependent on the risk profile that each
Yeah.
office has. And I would put this under the whatever the percentage of their portfolio they're currently comfortable with being in venture and growth. This would just fit into that bucket for me.
Right.
I
Right.
think of it as it's a sometimes more compelling, sometimes just as compelling entry point into those very same names they would be going directly on.
Yeah.
And so I think it's really nice from that point of view. Like I said, you can piggyback on, different sellers' relationships with the company. There's a lot of insider information flows that you can get, which,
Yeah.
you would otherwise have to get directly from the company, but can be
Yeah.
very hard. And so
Yeah.
you can still win that information from others, which is really nice.
It definitely seems like a highly, nuanced, there's a lot of dynamics at play, and that's why it's great that there are, specialized services such as yourself. Would you say that the dynamics are very different from just a traditional venture investment?
Yeah. Oh, my word. It's do you know what? Even more so than I was expecting when I started this
Really?
company.
Yeah.
Yes, really are.
Can you speak to some of those? Yeah, I mean, it seems very, very nuanced and a lot of dynamics at play, very relationship based, having that insider knowledge. But yeah, what can you talk to us about the differences and maybe some of the things you were surprised by?
Yeah, I think that's it's a great question. I think speed is one thing. And
Mm,
so it's a faster moving space. It really is. And so you have a little bit less decision-making time on each, set of supply that comes up in the market. Um, and so you kind of have to know what good looks like a little bit earlier than that, so that when you see it, you're ready to take it. That's a really different dynamic to, when there's a primary raise and the momentum is building up to that, there is a timeline essentially for that raise, and it all happens around that.
mhm.
So speed is hugely different in the secondary market. Um, there's also different supply and demand dynamics that I see in the space. And so, for instance, we have seen when an investor, starts telling a lot of folks that they really want a position, and then 2 days later, there is everyone wanting that position because they kind of led the pack. And
Yeah,
now there's no supply, and the pricing has all gone up. And
yeah.
so, being really thoughtful about approach to the secondary market can
Mm.
be a competitive advantage, which is quite a unique, interesting thing that I've noticed. Um, Pricing too. So, whereas a primary raise would, the lead investor would set a timesheet, which is agreed on by the company, and, that price is the full round.
Mhm.
Secondaries, because of some of those supply and demand factors, the pricing it's very much dependent on the needs of the seller. So sometimes you'll get someone who, I really need some DPI. I really love the company, but I'm willing to take a bit of a hit because of it. Or if it's personal circumstances, there's people who are saying, I just want to buy a house,
Yeah,
and
right.
my stock is illiquid otherwise. And so
Yeah,
I can take a discount to buy my house for my family. Um,
yeah,
which is
yeah.
part of what I love about this space.
I bet. I mean, you get to approach every situation with like your problem solving hat on and looking at all parties, making sure it's a win-win. So
Yes.
Exciting. That's awesome. So we have a question from one of our audience, and Frenchie asks, please differentiate the roles of each party between family offices and venture capital when they collaborate. And this is something we've been hearing a lot more, some of the benefits of collaboration, but yeah, from your perspective, I guess focusing on the roles they play.
Yeah. Yeah, it's an interesting question. I think it really depends on the kind of situation you're referring to, I think, Frenchie. What I've seen so far is I've had conversations with family offices recently who historically have done, primarily co-invest activities with VCs.
Mm-hmm.
And those folks are saying now more regularly, actually, this doesn't work for me so much because I feel like I get somewhat adverse selection on the deals that are showed to me through that co-invest. And so I kind of get the tier 2 companies that the fund doesn't want to, fully deploy themselves into. And so they come to other LPs. And so I
Yeah.
think that there's been a kind of a bit of a shift, at least from the conversations I've had, away from being oriented around co-invest.
Mm-hmm.
And so, yeah, that's kind of probably the main development that I've seen most recently in the relationship between the two.
Yeah.
Yeah.
Yeah. And Frenchie, you asked my question. It was really, Ben, you've been in this world of venture capital for so long. And, in terms of how the family offices interact and just how the whole ecosystem has evolved over the past 10 years, your comment on co-investing is really interesting. Are there any other ways that you've seen just the relationship between family offices, venture capital, the whole kind of ecosystem in general over the past 10 years? How has that really shifted? And then I'll ask my second question later, but yeah, where do you think it's going from here?
Yeah. So I think most recently the shift is I would say it's positive in favor of family offices.
Mm-hmm.
I think it's harder than ever to raise funds. If you're a fund manager, it's harder than ever. Whether you've been an established manager, an emerging manager, I don't think there's been in the last decade a harder time to raise capital. And so suddenly, folks who are LPs, that is, you've got a little bit more at the table to be able to negotiate with.
Yeah.
And so the selection is in favor of family offices, I think, on the LP side. I think also I'm seeing more family offices with an appetite to invest directly onto cap table or, make those direct investments. For example, we have a lot of interest on the secondary side to,
Mm-hmm.
access deals, and family offices, they know that the companies, that they want to get into, and they're using
Right.
secondaries in order to get into them rather
Yeah.
than waiting for kind of almost a permission from managers to tell them they can co-invest. It's actually
Yeah.
something they can go direct on now,
Yeah. It's
which
like
I
the
think,
back door in.
yeah, it kind of is. It kind of is. And I think obviously that comes with, different complexities around knowing the company policies. You can't always go direct. Sometimes, you need kind of some expertise in here is how a company thinks about that. But yeah, stepping back, I mean, I think that relationship between going direct versus not is starting to shift as well.
Yes, definitely. Curious, in terms of it being so difficult to raise capital right now, what are the biggest factors you would attribute to right now being such a challenge?
Yeah. And so I've spoken with a lot of funds recently and actually a lot of emerging managers. And I think that the factors are that, there was a lot of capital deployed into funds in 2021, as we
Yeah,
know.
yeah,
And so that there has just been a market pullback from that.
yeah,
I think it's a healthy reset for the ecosystem as a whole. Um, I think that is honestly the main reason. There's just
yeah,
kind of a natural reset off the peaks of 2021. I think obviously there's some macroeconomic factors around that.
right.
Um, but I think this is a positive for the ecosystem as a whole.
Exactly. We have an ebb and a flow. It's been interesting to observe many companies that I've seen that used to focus on capital raising now shift into more, we'll market or we'll do this or that, but the capital raising is just so hard, it's not an easy
Oh,
job to sign up for. Although in our discussion, was it you, Ben, that mentioned you actually really like capital raising? It may have been a different conversation. You're like, no, not me.
it might have been another Ben. It might have been another Ben.
Um, we've got a question from Ryan. He
Yeah,
asked, do you think VC and family offices in the US are less risk adverse than those in Europe? And the reason to grow fast?
that's a really interesting question. What I've seen a pattern of recently has been actually, interestingly, family offices in Europe are more interested in US funds and
Mhm.
vice versa. I've found US family offices have been investing more into European funds.
Mhm.
I don't know if that is, backed up by data. It's definitely just kind of something I've been seeing.
Yeah.
Um, so I think there's a little bit of that, which would maybe suggest I don't really know what that suggests in terms of risk aversion, to be honest, but it's definitely a phenomenon that I've seen across those two continents.
Yeah. It makes sense. You think, you want to invest in those areas, but maybe don't have the boots on the ground, experience. So going with a fund manager who's there,
Yeah.
and interesting to see, the inverse happening. Great question, Ben. Um, let's see. We talked a little bit about co-investments and family offices. I guess, just talking about direct investing as well. How can family offices balance direct investing with fund investments to maximize their impacts and returns?
Yeah. Hmm. That's a tough question. I think it really depends on, your expertise and specialism in venture.
Yeah.
I think frankly, if you're just dipping your toes in and you don't have any history, or, you know, you haven't hired folks with history in venture, it can be very tough to begin at the very start. And so therefore would always suggest going via good GPs that you can also learn from along the way. And, that's not so much about maximizing returns, but I guess over the long term it is.
Hmm.
And based on, I think there's some interesting kind of pro rata things going on right now, which I think family offices are really well placed to capitalize on. And that is if they ever invested in earlier stage funds who don't have the capital to deploy later, and
Hmm.
they want to do follow-ons, but they just haven't raised enough cash for that,
Hmm.
then family offices who are LPs in those funds that want to continue, that's a great source of capital to take up pro ratas. And I think that's a really nice one because you get some insider information on performance essentially, which you can then use to point and um, take the most interesting companies to the
Yeah.
next level.
Yeah. Excellent. It's one of the many reasons these family offices make such great investors. Another question from Frenchie, with the increase in private equity, how is the competition for venture capital in closing deals with family offices?
Yes. I haven't spent enough time with private equity to be able to give you a good answer, is the truth.
Yeah.
I'm really focused on venture, and I mean, if you're talking about kind of growth equity, then I think there is um, a good amount of interest in those later stage de-risked names, particularly at the kind of pre-IPO level. So I would call that to some extent private equity. I think tangential to private equity, though, you've got, I do think the secondary asset class, venture secondary asset class is more of a PE style model because you can, find and take equity in interesting companies, basically, to some extent on demand with some caveats to that. And so that is an emergence. But yeah, if you're talking about traditional PE, I haven't got enough data points to be able to give you a really conclusive answer.
Yeah, and even that in and of itself, it's not affecting what you do. So you're not feeling necessarily the competition in the world of secondaries. It's just not an area. Well, everyone, you guys have been an amazing audience. I love all the questions. Does anyone, there may have been some in the chat that I missed earlier, but does anyone have any additional questions for Ben? This has been awesome, Ben. So tell us a bit more for those looking to learn. Tell us your website. I know you dropped your LinkedIn. I'll be sure to follow up with that in tomorrow's recording, as well as your Calendly. So if anyone wants more of kind of a one-on-one. But yeah, where's the best way to learn more?
Yeah, totally. Maybe I just quickly answer Ryan's last question there as well. I Does VC and family office in the US prefer startups registered in the country, tax and benefits purposes? Um, I think it's to some degree case by case. For example, we've seen an emergence of interest in the Indian ecosystem, and there's a lot of value there. There's a lot of it's a really maturing industry, a venture economy there. A lot of the companies there are, getting that kind of pre-IPO level with an IPO window that's generating a lot of excitement. And yet there is a lot of interesting tax implications, and there is some kind of, lockup periods they require some specialization in order to access. And so I think only funds that really are committed to some other countries like that are equipped to benefit from those ecosystems, to be frank. And to Frenchie's question, what do I expect for the industry going forward? I expect a venture consolidation. To be candid, I think there's going to be a lot of funds that will struggle to meet the DPI levels that they need in order to generate the next fund and raise it. And so I think there'll be some consolidation on the long tail of funds. I think you'll continue to see kind of a bifurcation of value add and how you construct your fund. To my earlier points, I think there are funds who are all in on value add, and they do incredible work helping companies, and they win deals because of that. Like my old fund, Insight Partners, is amazing at that. In A16Z is amazing at that. And then you've got on the other side, just hyper, they are very small and they've got a small number of employees, and it's almost kind of venture purists, and like the Union Square Ventures of the world. And so I think you will continue to see that bifurcation, as well as some of the consolidation of early stage funds. And I do think the secondary market will continue to grow in prevalence. I think more and more sophisticated investors see it as a great entry point into venture, a great top-up point to get more of things they love. And so I think we'll see more of a normalization around secondaries in the venture ecosystem. So yeah, so a few thoughts on that one.
Yeah, and that Freya, does that answer your question as well? Freya asked in the Q&A, kind of what's the recent trends for VCs, family offices, et cetera, in the US and Europe. And so you kind of talked about the future, what we expect going forward, but kind of, yeah, some recent trends as well.
Sorry, I haven't seen that one. I'm not sure if I can actually see.
So there's a separate Q&A.
Oh, okay.
Keeping you on your toes, just when you think you're done. This always happens. I'll be like, great, well, thank you. And then all the questions start coming in. But Freya asks, what's the recent trends for VCs, family offices in the US and Europe? Which, I mean, you talked about where things are going, but yeah, recent trends.
Yeah, I think some of those trends I just mentioned, I think that I mean, I think, there is, of course, a lot of, in terms of, if you're thinking about trends in terms of focus areas and technologies that are interesting, I think we'll continue to see, data and AI take a front foot. There's a lot of amazing things to be done there. There's also things that aren't going to work. I think, so we've got a great network of chief information officers across Fortune 500 that we tap on to, it's part of the value add strategy, right? Around, we use them to vet things and to get responses. And, we've got a really great relationship with all these IT senior leaders in Fortune 500. And I think right now, actually, the very immediate trend we'll see is that they are getting a little bit disillusioned with some of the immediate results that AI is generating.
Oh, wow.
Um, and they are under a lot of pressure from board members and CEOs to generate high ROI across an enterprise.
Mhm.
However, the results in practice right now are just not quite living up to that. But I think taking a slightly longer term view, 5-10 years, that will, that's kind of almost a J curve, and I expect that the results will pick up as the technology continues to develop. So yeah, data and AI, I think cybersecurity is, going to continually increase in its
Yeah.
prevalence and interest, and I think we'll see more platforms emerge in cyber, and movement away from point solutions and features. I think that it's not a space I've spent a crazy amount of time in, but I do think that there's more and more interest in defense. I think some
Mhm.
of the kind of global um, dynamics right now would, that creates a lot of need for high defense spend, and I think we'll see more spend, and I think we'll see great technologies coming through, which, for better or worse, frankly, are industry. They've been practiced in field,
Right.
and so yeah, those are kind of a few things that I think will happen next.
Yeah, and we were talking yesterday, I was telling you, just in the specific world of family offices, I'm kind of encouraged and excited that there's a lot focus around mental health and
Yes.
being, and that's exciting, longevity. So yeah, lots of exciting things on the horizon.
Yeah, there's some amazing companies in that space. It's wonderful.
Yeah. Um, so Jacqueline asks, how do you view the interest in climate tech?
Um, do you know what? I honestly haven't spent a huge amount of time in it. I wouldn't be able to tell you with any level of sophistication what I think about it. My focus has always been kind of enterprise technology, a little fintech, and tiny bit of healthcare. So climate tech is just something I haven't spent as much time in.
And I'll just from my experience, one of our partners at Digital Evolution Institute, Tracy McWilliams, she runs a family office out of Los Angeles, but she has Global Inspire Ventures, and it's dedicated to early stage venture investing in companies addressing climate tech. And so I know, I mean, just because she throws lots of events that we attend, but there is a lot of interest, growing interest amongst family offices. And I think you do get a lot of kind of the next gen leaders who are really thinking about the future and where they can put their wealth that will improve the lives of the generations to come. So I'm, again, encouraged by a lot of these trends I see, at least in the world of the family offices.
That's incredible.
Yeah.
Yeah, and I guess you speak to so many different family offices. I'd love to ask, what you said, mental health is a big emerging trend. Are there any others you're seeing right now?
Yeah, again, it may be that the conferences I tend to go to do have themes, and I get very immersed. I go down the rabbit hole, but I mean, everything you mentioned, it's just what's pertinent to them. I mean, real estate will always be one. It's just an asset that's understandable and makes sense. But I do see climate, impact investing. I think mental health and just longevity, but
Yeah,
things that are out of necessity as well, technology, AI, cybersecurity, all things you touched on. Trying to think if there's anything kind of outlandish. I think as well, education always plays a big role in many of the families. But yeah, it's interesting. There's no two are alike, but
right.
and it's you can go from city to city, and depending on the industries and things that are really prevalent there, sometimes it does persuade a family who wants to invest in the things that are local to them. But yeah,
Yeah. No, that's fascinating.
yeah. Well, this has been awesome. I appreciate it, Ben. Thank you so much. I know how busy you are. This has really been generous of you. I've learned a ton. So I appreciate everyone's great questions and for hanging out with us today. And we'll be sure to follow up tomorrow with the recording and information on how you can get a hold of Ben.
Yeah, no, thank you so much, Danielle. I really appreciate you hosting me, and thank you everyone for coming as well.
Enjoy the rest of your day. Good luck with your deals. All
Thank you. Bye
right.
bye.
Bye-bye.